The rate of return myth. The majority of effort in our society is placed on investing in the market, but is this the best strategy? Let's look at how the financial services industry represents their returns as an average per year over time. The common strategy is to put money into the stock market and leave it there. Why? Because they say it always comes back, and the average for 100 years is over 7%, or so they say. In fact, the Dow Jones Industrial Average for the past 100 years has averaged 7.26% using the calculation method shown on the next page. Let's see if that fairly represents real life. If you were to put $1,000 in the Dow Jones Industrial Average in 1909, what would it look like in 2008, 100 years later? The value of your account in 2008 should grow to $1,106,061. However, had you actually invested $1,000 in the Dow Jones Industrial Average in 1909, your account balance would be only $142,954. So, what has happened? That's $963,107 less than what it should have been. This is due to the rate of return myth used to get people to invest in the market. The returns shown for the 4 years are typical for the stock market, 401ks, IRAs, and other money market vehicles. The total returns for these 4 years is 32%. And when you divide the 4 years shown, it says the market returned an average of 8% per year. Sounds good for an investment with a projected 8% average growth for 4 years. The value of the investment should grow to $13,604.89. Now let's take a look at the actual growth of the money in the investment account. After the first year and suffering a 50% loss, your cash is down to $5,000. During the second year, you realize a 50% increase on your investment and your money grows to $7,500. In the third year, the growth is 24% and your money grows to $9,300. By the fourth year, the balance in your account is $10,044. This is a far cry from the $13,604 that was expected. After 4 years, your profit is only $44. The total percentage growth for the 4 years is less than 0.5%. The average growth per year is only a little more than 0.1%. So what has happened? The person selling the investment stated the investment had a history of 8% yearly average. He didn't tell how the downs in the market will have a negative impact on the growth of your money. Let's compare how a safe money savings plan protects your principal even when it is indexed to the same market returns. Index savings accounts generally have a cap, which is the maximum amount of growth allowed in a given year in exchange for the value of the account never going down. After the first year, your cash value remains at $10,000 because of the index savings account, which uses the annual reset crediting method. The money in your account will never go down when the market has a negative return. The second year provides you with a 10% increase in your savings and your money grows to $11,000. Remember, the account has a 10% cap. After the third year, the growth is 10% and your money grows to $12,100 limited by the 10% cap. During the fourth year, the balance in your account grows to $13,068. Your profit after 4 years is $3,068. Total increase for the 4 years is 30.68%. The average growth for the 4 years is 7.67%. Having $1 million for retirement is not an impossible goal. Don't be swayed by the promises of high average returns on investments as shown on the previous slides. They can be disastrous for you and your family. The downs of the stock market can destroy your future. I believe in the safe money concept and feel that the downs of the marketplace affect your retirement savings negatively and the losses are rarely ever recovered. Your money can be lost forever. Remember, with safe money savings you participate with all the market gains but never participate in any market losses. Zero becomes your hero.